Welcome in. Today is the big map. One video, the major options strategies, and for each one the honest pro and the honest con. No strategy is magic. Every single one is a trade-off between probability, payoff, and risk. By the end you should know what each tool is for, and just as important, what it costs you. Quick framework before the tour. Every options position is built from 4 bricks: buying calls, selling calls, buying puts, selling puts. Buyers pay premium and get defined risk with a low probability of a big payoff. Sellers collect premium and get a high probability of a small payoff, sometimes with undefined risk. Everything that follows is a combination of those bricks, and every combination lands somewhere on that same seesaw. Start with the long call, buying a call outright. You pay premium for the right to buy stock at a strike. The pro, leverage with a hard floor. You control 100 shares for a fraction of their cost. Your loss is capped at exactly what you paid, and if the stock rips, the upside is unlimited. The con, time is against you every single day. The stock has to move up, move enough, and move soon. Most long calls expire worthless, and you can be right on direction and still lose money because the move came too late or was already priced in. The mirror image is the long put, buying the right to sell at a strike. The pro, it's the cleanest insurance in finance. Defined cost, big payoff if the market breaks, and it's the standard way to protect a stock position through an event without selling it. The con, insurance is expensive, especially when you want it most. Implied volatility inflates put prices right when fear is high, and if the crash doesn't come, the premium bleeds away to zero. Buy protection constantly and it will eat your returns alive. Now the workhorses of income trading, starting with the covered call. You own 100 shares and sell a call against them. The pro, you get paid to wait. The premium lands whether the stock goes up a little, sideways, or even down a little. It lowers your cost basis every time you do it. The con, you've sold away your home runs. If the stock rips through your strike, you're capped, watching the rally from the sidelines, and the premium is only a small cushion. If the stock truly tanks, a covered call barely softens the blow. Its sibling is the cash-secured put. You set aside the cash to buy 100 shares and sell a put at a strike where you'd be happy to own them. The pro, you get paid to make an offer. Either the put expires and you keep the premium, or you buy a stock you wanted anyway at a discount to where it was trading. The con, you have full stock risk below the strike, and the market only fills your order when things are falling. You'll be handed the shares in exactly the moments they look ugliest, and your capital sits parked in the meantime. Put those last two together and you get the collar. You own the shares, you buy a put below the market for protection, and you sell a call above the market to pay for that put. The pro, cheap insurance, often close to free. Your downside is fenced off at the put strike, and in a nasty market that fence is worth everything. The con, you've boxed yourself in on both sides. The sold call caps your upside just like a covered call does, so you've traded away the good tail to eliminate the bad one. A collar is a fine tool for protecting a large position you can't or won't sell, and a frustrating one in a bull market, where you'll watch your stock get called away over and over. Next, spreads, where you buy one option and sell another to shake the risk. Start with the debit spread, the directional bet on a budget. Buy a call, then sell a further out call against it, which refunds part of the cost. The pro, you've cut the price of your opinion. The short leg subsidizes the long one. Decay hurts far less than owning an option outright, and both your maximum loss and maximum gain are known to the penny before you enter. The con, you've capped your winner. If the stock blows through both strikes, you make the width of the spread and not $1 more. The lottery ticket upside is exactly what you sold to make the trade affordable. The credit spread is the defined risk version of premium selling. Sell a put, buy a cheaper put further out as a backstop. Keep the difference. The pro, your worst case is written down before you enter. The distance between strikes minus the credit, that's the most you can lose, period. That makes sizing honest and blow-ups impossible. The con, the backstop isn't free. The long option eats a chunk of your premium, so you risk several dollars to make one, and a losing streak can undo weeks of small wins. Probability is on your side. The payoff ratio is not. Stack a put credit spread under a call credit spread and you get the iron condor. The strategy for markets going nowhere. The pro. It's a defined risk bet on boredom. If the stock stays inside your range, both spreads expire and you keep everything, and you don't need to guess direction at all. The con. The profit zone looks wide until the market trends. One strong directional week can put you at max loss, which is usually 3 or 4 times the credit you collected, and defending a breached condor is awkward at best. The undefined risk version is the short strangle. Sell a put below the market and a call above it. No protection on either side. The pro. This is the purest form of the seller's edge. Maximum premium. The widest profit zone of anything in this video, and it wins if the stock goes up a little, down a little, or nowhere. The con is the big one. Unlimited risk on both sides. A gap through either strike can hand you a loss many times the credit, and one unmanaged disaster can erase a year of income. This is a professional's tool. Small size, big account, strict rules, or not at all. Flip a strangle inside out. Buy the options instead of selling them at the same strike, and you get the long straddle. Buy a call and a put at the money, and you own the move itself, whichever way it breaks. The pro. Direction stops mattering. Earnings, a court ruling, a product launch. If the stock moves violently either way, one leg pays for everything. The con. You're paying double premium. Decay runs on both legs at once, and the market usually knows the event is coming. Implied volatility is jacked up before you get there. The stock doesn't just have to move, it has to move more than everyone already expected. One more for the vol curious. The calendar spread. Sell a near-term option and buy a longer-dated one at the same strike. The pro. You're harvesting the steepest part of the decay curve. The front-month option you sold decays much faster than the back-month option you own, and if the stock sits near the strike as expiration approaches, that gap is your profit, all with defined risk at entry. The con. It's secretly a volatility trade wearing a direction costume. A big move in either direction hurts it, and a drop in implied volatility can sink the back-month option you own even when the stock cooperates. It's the first strategy on this list where you can get the stock exactly right and still lose on the volume last one. Less a position than a system. The wheel. Sell a cash-secured put on a stock you want. If you're assigned, sell covered calls against the shares until they're called away. Then start again. The pro. It's premium income at every stage with a plan for every outcome, and it forces the discipline most traders lack. You only run it on stocks you genuinely hold. The con. The wheel doesn't remove stock risk, it schedules it. In a real downtrend you're buying on the way down and capping your recovery on the way up, and the tidy loop can turn into holding a loser for months. So how do you choose? Ask what job you're hiring for. If you want a directional shot with a hard floor, that's a long call or put. If you want income from what you already own, covered calls. If you want to buy stocks cheaper, cash secured puts. If you need to protect a position you can't sell, the collar. If you want a directional view at a discount, debit spreads. If you want the seller's edge with your worst case in writing, credit spreads and iron condors. If you want maximum edge and can genuinely carry the risk, the strangle. And if you expect an explosion but don't know which way, the straddle. Notice what's on that whole list. Nothing pays you both a high probability and a big payoff and a small risk. Every strategy trades one for another. The traders who last aren't the ones who found the perfect strategy. They're the ones who know exactly which trade-off they're making, and size it so no single mistake matters. This video is for information and entertainment only. Nothing here is financial advice or a recommendation to buy or sell any security. Options involve substantial risk and are not suitable for everyone. Do your own research and size your own risk.